We have just a couple of minutes here until the closing bell. We have Ryan Detrick of LPL Financial and Eric Winograd of AllianceBernstein here joining us. Jared Blickery, I want to go to you first. Just a couple of the movers that you're watching here into the close. What's catching your eye?
I'm watching the People's Index. That would be the Dow. And let's take a look at the charts because pretty interesting price action today. Powell didn't spook the markets. The reaction was on that 2 p.m. report, and we are flagging near highs right now. So constructive price action. And just to show you a 2-month chart here, because this is a record high for the Dow, hit it just after the report was released at 2 p.m. The S&P 500 a little bit later there. That's good for an intraday record high. And we also want to check out the VIX here, solidly below 20. Haven't seen this for a while. This could be 2 closes in a row. Haven't seen that in over a year. And also taking a look at the bond market. And this is key because the bond market was not spooked today. Up only 2 basis points, holding its ground. So are stocks. Now, if we look inside the Nasdaq 100, we're still seeing some weakness centered around some of these tech names, like Apple is a big standout. That's down 0.9% in the upper left. But check out Tesla. This stock began the day in the red and has just climbed solidly in the green. Had been a rough day for EV, not anymore. Also seeing some strength in semiconductors. Micron is up 3.5%, Microchip up over 2%. Very impressive to see this, given the fact that we do have higher yields today. So we'll talk about that with Ryan Detrick in just a couple minutes. Also, the sector action for today. Guess what? Consumer discretionary surging into the lead. That's up over 1%. So are industrials. They had been leading earlier in the day. And then materials, energy, and financials all outperforming. And it's worth taking a look inside the banking sector. We have JP Morgan close to another record. So is Goldman Sachs, each up close to 1% or a little bit more. Capital One Financial, Capital One is up about 2% here. And also checking in on GameStop, because guess what? It's not only Fed Day, we also had a GameStop hearing, the second one in the House Financial Services Committee, and it is up 0.5%, but you can see pretty volatile going into the close here. And then finally, what's the last thing we're going to do here before we ring the bell? We're going to check on Bitcoin. That is up 5%.
And that rounds out today's trading day. Again, all three of the major averages closing in the green. Dow, S&P, and Nasdaq in positive territory. You can see the Dow closing up 190 points, S&P up 0.3%, the Nasdaq up 0.4%. Jared was just going through the sector action for us. Consumer discretionary, industrials, and materials leading the way today. And then, of course, the big story is what we saw in the bond market. We have higher yields today on the heels of the news that we got out of the Fed, the fact that they're not planning to raise rates, they're not adjusting their bond buying strategy anytime soon. But we want to talk a little bit more about this with our panel. We want to bring back in Ryan Detrick and Eric Winograd. Eric and Ryan, great to have you both here. Ryan, first you, just on the action that we're seeing in the bond market here, the fact that we're seeing yields push a bit higher today. What's your reaction to that, and does this make sense?
Yeah, it makes sense. You know, like you said, 2 weeks ago, remember when Jerome Powell talked, he opened his mouth and said everything was okay. What did yields do? They spiked higher. Now today, the bond market has a much more subdued move. And as a reaction, you know, you've got the higher stock prices. I mean, it is St. Patrick's Day, so I think it only makes sense that we have some green out there as it comes to equities. But the truth of the matter is this, right? I know some of the recent economic data has been a little weak. The guest before me talked about some of the disappointing housing data. That's true, but let's be honest, I think it's due to weather, and the economy is going to really open up. And that, again, is what the stock market sees, and that's why the 10-year yield continues to track higher. The bond market is telling us the economy is going to be better. Likely stocks will continue to outperform bonds. I've been saying it for a while with you guys, and we still think that's the case here.
Well, Eric, I want to get your take on the FOMC decision today and Jay Powell, who managed not to spook the markets, and in fact, quite the opposite. What's your takeaway on today's meeting?
I think that's right. Look, the Fed and Chair Powell could not have been very much more dovish than they were today. They acknowledged that the incoming economic data is going to be very strong. They upgraded their forecast for this year. They upgraded their inflation forecast for this year. You know, the central bank is now projecting 6.5% growth this year. And simultaneously, they told us that they are not planning to raise interest rates through the end of 2023. So that is a very long and extraordinarily long period of extraordinarily accommodative monetary policy. So, you know, again, it is as dovish as they could plausibly have been. And I think markets reacted to that.
Right, I know you're extremely bullish here. You have been for quite some time. When we talk about the risk of the Fed waiting too long, we talked about that with our guest earlier last hour. What's your reading on that? And I guess, is there a bigger risk to wait too long or to act too soon?
Well, I think it's probably way too long, to be honest. You think about it. I mean, before today started, right, the market, Fed fund futures were saying there'd be a couple different rate hikes in 2023. Fed saying, maybe not. So that's one thing. I mean, the whole inflation argument, I mean, believe me, we could talk about inflation all day long. Those industrial metals, copper, nickel, zinc, lumber, those things are all saying there could be more inflation coming. But overall, we're with the Fed. This is likely transitory, the higher inflation we're going to see. And the globalization, the Amazon effect, all those things that have kept inflation low for so long are honestly still in play. So inflation is not something that keeps us up all night, maybe a little bit at night sometimes, but not all the time.
Well, Eric, I want to get your take on something interesting that's happening in the markets, and that's value. Value stocks are becoming momentum stocks. And you put those two together, I think one Wall Street firm said that is the holy grail. Can value stocks become the new norm in the momentum game? Because we haven't seen that in forever.
I think it's a good question, and I think that we will see as the year progresses. One of the things that we have seen is that the impediment or the potential impediment to strong stock performance, even in this very accommodative environment, has largely to do with valuations. And when you look at valuations, it seems reasonably clear that growth stocks have run well ahead of where value stocks are. And so if you do see a little rotation there with value stocks playing a little bit of catch up, they could gain some momentum. And, as we're looking for the market to continue to go up, if we think that the economy continues to go up, as I think we do, then maybe that rotation makes some sense. And the laggards from last year may catch a little bit of a bid here.
Ryan, are you still seeing any opportunity in some of those big tech names? As we talk about the rotation there, some investors are pulling money off of the table. What's your view on that?
Yeah, we do. I mean, we're more of a year ago when we talked to you, I said, we're overweight growth significantly over value. Now at LPL Research, we're more 50-50. On that quick 10% correction we saw in the Nasdaq a week ago, even more in some of the other names, there's still some decent values there, but kind of like we just talked about, cyclical value is kind of where it's at, right? As the economy opens up, that is the area that probably can continue to lead. And just think about this for a second. Financials and banks are like trading exactly where they were 13 years ago. Okay, so to think, yes, tech is up a lot, is the market up a lot? There's other parts to the market. I think investors forget that. Financials have gone nowhere for 13 years as the yield curve steepens, a little more inflation, a little higher rates. We think financials, that big part of the value trade, obviously, can continue to lead again because they've gone nowhere for 13 years. That's bullish longer term in our view.
Ryan Detrick, always great to speak with you. And Eric Winograd, third time is a charm. I finally got your name right. Thank you to you both for joining us here today.